If you want to build a sustainable company, it's best to treat doctors as partners and let them be vested in the business, whether at the local level or at the parent company level. And the premise is that they're going to work harder, they're going to stay longer if they get to enjoy that upside. So it's really about aligning incentive. It's not really about necessarily being generous, but aligning incentives so that everybody does better long term.
Good day, everyone. This is Dr. David Phelps of the Freedom Founders community and the Dentist Freedom Blueprint podcast. Today, I've got back with me one of my favorites, and I think one of yours too, because he brings so much relevance to our space in dentistry, and particularly as to a lot of the movement in practice transitions today, and that is Mr. Brannon Moncrief. Brannon, great to have you back.
Hey, David, good to see you. Thanks for having me.
So, Brannon, a lot of people know of you, but there's always going to be some that don't, and so it's always relevant to just give a little bit of your background. I know for a fact that you graduated from Texas A&M back, several decades ago, and you evolved, from your training and your background and your degrees into the world of finance, which got into dental lending early on, and you did that for about a decade, and then you moved into the seller side representation of practice transitions, took over and own and run the McLaren and Associates group, transition practice broker group out of Austin, Texas. So that's my overtake. Fill in any gaps there that might be beneficial to our audience.
Yeah, well, I think you got it. I've spent my whole career in dentistry, in the M&A side of dentistry. About a decade as a dental lender, and the past 12 years as a broker, sell-side advisor for both doctor-to-doctor practice transitions, as well as, more recently over the past 5 years, leading our team that handles, large practice sales to DSOs and private equity. But most of our team sits in Austin. We have an office in San Diego on the West Coast. We have an office in Atlanta on the East Coast. And I live in Austin, have 2 young daughters, 7 and 3. So spend the little free time I have chasing them around.
Well, it's busy for you in all respects, personal life, business life, and great job that you do. You're very prominent in the space, and I say that with all respect. In any kind of business transactions, financial markets, we people who are in the business realm and doing transactions or wanting to do transactions, it's more and more important today than ever, I believe, and I think you'll back this, to have really competent advice. Maybe not just from one person, but we need a team, right? And I think you help make sure people have a team to navigate the different challenges, opportunities, and challenges that one might go through in figuring out what we're talking about today here, and that's the kind of the transition marketplace. So you mentioned that things kind of started to move toward larger practice sales and DSO sales primarily in the last 5 years. That's kind of what I've seen, even though private equity slash, if you want to call it, DSOs have been around for actually a couple of decades, but on a very much lower level. We've seen this rapid rise, and we'll talk about that in a minute. In the last 5 years particularly. I'm curious. Let's go back maybe 3 years ago. So let's go back a little bit before COVID, maybe 2019. What was the ratio, if you can remember, or give us a rough guess, ratio of dental practice private sales versus going to a DSO route? What was kind of the ratio generally? What was the blend back then?
I'd say back pre-COVID, the traditional, practice sale doctor to doctor was still the most prevalent model, but the DSO private equity world was definitely picking up steam going into COVID. With the research I've done, there were about 150 to 200 DSOs pre-COVID, and now, we've got 400 to 500 DSOs operating nationwide. It's hard to say what that means as far as size goes. Being a DSO is simply a legal distinction. It means typically that you have a non-practice owner involved or a management company involved. So that could be as small as 1 location or as large as Heartland, 1,500 locations.
Right.
So it's definitely grown, and we're seeing more and more DSO transactions, more and more doctors calling saying, hey, I'm interested in selling to private equity or affiliating with the DSO, as opposed to 5 years ago, those calls were few and far between.
What was you say the ratio is today, like this summer, private to DSO? sales?
For our company, as far as number of transactions, it's about even.
Yeah.
A lot of that is by default. A lot of practices collect less than $1 million and don't have a lot of EBITDA, so they're non-acquisition targets for DSOs. What I can tell you is, both sides of the market are healthy. We have healthy demand, on both sides of that equation as well.
What do you think has been some of the primary drivers for the DSO backed by private equity to have this multiplying effect, as you said, in the last 5 years, from a little bit pre-COVID to the great surge that we've seen in just the last year and a half since kind of post-COVID?
We'll talk on the buy side first. So private equity was heavily interested in dentistry pre-COVID. Dentistry is a highly fragmented, very profitable industry that can benefit from organization, consolidation, leveraging economies of scale, both with vendors and payers. So private equity was doing very well in the dental space in the 5 to 10 years leading up to COVID. All private equity knew about dental, and those that weren't in at the time COVID hit were certainly interested. It was one of the hottest verticals in private equity going into COVID. And then when dentistry rebounded so quickly, as quickly or more quickly than any other medical vertical that private equity was interested in, PE doubled down. We had, a lot of DSOs turn on the green light once practices opened back up. Their banks were ready to lend, interest rates were low, and they began to acquire practices at an even faster clip than they did pre-COVID. And then a lot of private equity firms that were not yet in the dental space decided to make an investment, buy a platform, and begin to grow. So that's the primary reason that private equity loves dental, both pre-COVID and especially post-COVID. On the sell side, we've got a lot of large group practices, whether they be multi-doctor or multi-site. That phenomenon is really something that's caught fire in the past decade. I'd say 2010, most practices, 1, maybe 2 doctors. But now we have these mega practices all over the country, multi-site, multi-doctor, oftentimes multi-specialty practices that are worth far more in the private equity DSO world than they are in the private buyer world. There aren't a lot of private buyers out there that can afford or have the confidence to buy a practice that does $5 million a year in revenue. Whereas private equity DSOs absolutely love those practices because their size and caliber, they're generating a lot of EBITDA, a lot of passive cash flow, if you will, for the investor. So economically, it's become very compelling for large practice owners to at least consider going down the DSO road because of the massive delta between the private buyer valuation and the DSO valuation. And then I'll also say, DSOs for the most part have learned how to stay in their lane. They support the practice behind the veil from an administrative perspective. They're not patient facing. They don't rebrand the offices. They just help leverage economies of scale and help with the admin piece of the practice, which most doctors and staff members really don't enjoy doing those tasks on a daily basis anyways. So they've learned to stay out of the operatory, allow for clinical autonomy, allow for a lot of operational autonomy, and just support the practice in the background. And then, third, they've allowed the doctors to retain equity, roll equity, and participate in the arbitrage, the investment return that private equity is generating. Whereas, before 5 to 7 years ago, most DSOs bought 100% of the practice. There was really no upside for the doctor. They had to stay on to fulfill their post-closing employment agreement. They had some type of earnout related to fulfilling that commitment, but there was no equity component. So that's been kind of a new iteration in the DSO world, is allowing the doctors to invest alongside private equity and, enjoy the upside there.
Let's just take that last piece. Why do you think that is? As private equity just being generous?
I don't think so. I think, DSO 1.0, that version of DSOs, many of them didn't succeed. And that's because they treated doctors, founders as employees rather than partners. And doctor turnover, founder turnover is the Achilles heel of most DSOs. So if you want to build a sustainable company, it's best to treat doctors as partners and let them be vested in the business, whether at the local level or at the parent company level, and the premise is that they're going to work harder, they're going to stay longer if they get to enjoy that upside. So it's really about aligning incentives. It's not really about necessarily being generous, but aligning incentives so that everybody does better long term.
So when we talk about sales here, and my background, I come from real estate, but there's a lot in common here. Basic structures, you know the whole game. And when I think about a sale in real estate, I typically think about I have something that a buyer wants, a piece of real estate, and we determine a price. And if we agree, they cut a check. I give them the keys. I'm gone. There are ways to do participations, but typically that's a sale. There's other structures, again, going to real estate. There's lease options, lease to own, lease to buy. And to me, that's more what I look at as the DSO structures, where they write a check up front, but not for the full quote valuation. And then, we call it, you call it, the marketplace calls it a quote partnership, but it's a subordinated partnership, as we know. The selling doctor takes a minority position in that quote partnership, and is essentially like a lease to own in real estate, is basically paying, in my opinion, for a great amount of that equity piece by staying on and paying rent. Give me your take.
Yeah, I mean, there's always going to be some sort of equity component, in these transactions, and the seller in some form or fashion is going to be tethered, to the office or to the parent company, for at least 3 to 5 years. It used to be 2 to 3 years. Now it's 3 to 5 years. So I think, to your point, doctors have to understand that if they're going to take some chips off the table, they're going to be selling a majority ownership interest in their practice. They're going to take a significant pay cut. They're going to lose or give up all the EBITDA of the practice if they enter into a holding company model where they sell 100% of the practice to the DSO, and they have to evaluate, what is the cash up front worth to them? What is the administrative support worth to them? What is the equity component worth to them? And what is the risk in that investment? Because, DSOs, private equity will tell you that it's essentially risk-free. And I know that there's always risk in any type of investment. It's a calculated risk to some degree. And I would say that, in a holdco model, when you own stock at the parent company level, you don't have as much insight into the risk profile and the potential return on that investment as you do in a joint venture model, where you actually own the equity at the practice level, and your practice level EBITDA in a large way contributes to that value of that equity component. So you've got to evaluate what's your why, right? Why are you doing this? What does the taking chips off the table mean to you? What does the admin support mean to you? How risk averse are you from an equity perspective? And then how are you going to fund your lifestyle needs along the way while you wait for that reward, that liquidity event, and that return at recap?
Yeah, great points. So yeah, we know it's not risk-free at all. Nothing is, as you said. We both know, because we're involved in our own respective perspectives in a lot of the dental media, the forums, the conferences. So you and I both, and I look at it, I'm always interested, because I fortunately I get to deal with docs who are many of them are on the exit path, and our piece is not transition brokering them. I need people like you to bring that to the table. It's really what you just said. How do they take equity and actually put it to work in the best way possible to replace the active income they were producing off the equity that they just gave up? So we're in the same circles, and you and I have both seen really for the first time in the last, really probably the last 2 months, I've seen a lot of channels talking about a lot of negativity, a lot of disenchantment from people who have direct experience. They're in the game. They made the deal. They made the partnership. And there's certainly outside lookers who are always taking one side or the other. It's all greater. It's not. I don't really look at those people. It's like, who's actually in the game? You're in the game. You get to see inside baseball all the time. But I get somewhat of an inside look. And we both know, and we were talking a little bit before we jumped on this conversation today, is that there are a number of private equity backed DSOs that are in different levels of trouble. Some have just blown up. You mentioned rolling equity over into the shareholder company. Well, this is public, so I can speak of it. North American Dental Group. they're being sued by their minority shareholders, and I emphasize shareholders who can't even get the information they want. They have to go to litigation. So there's those people are not, those shareholders are not happy at all. There's a number of others, and again, we're not going to talk about the list because, but you have it more inherently than I do. Number who are missing and delaying promised recaps. What's happening?
I think it's important to just note that we're operating in a completely different environment than we were, even a year ago, much less 2 years ago. And that's driven by interest rates, doubling, and then the capital markets being extremely tight. Banks are hesitant to lend, and they're scrutinizing, the balance sheets and the P&Ls, not only of DSOs, but of all private equity-backed companies. So I think it's important. A lot of people are talking about, some of the trouble that is brewing from the DSO side of the space. But the reality is this is happening in real estate. It's happening in a lot of other medical verticals. Anyone who was relying on borrowed funds to fuel the growth of their business is, in some way under some sort of pressure or duress at the moment. But there is definitely a delineation within the DSO marketplace of those that are in real trouble, like you named, NADG, and those that are continuing to thrive and are going to accomplish their goals from a financial perspective. They may not recap over the next 12 to 18 months, but they will certainly recap at some point in the near future with what we project as favorable returns.
But Brandon, I just gotta say, and this is all due respect, and I'm just looking at the real estate markets. How can we quote guarantee they're going to recap at a certain number? How can you or I say that? Because I talk to my people all the time. There's no guarantees, especially in the commercial space, which is very similar to private equity. It's short-term money, which, as you said, has more than doubled in the cost of capital. And there is heavy headwinds in the commercial real estate space. And there's this lag effect. We both know there's a lag effect. What's been going up, the rates, the fastest rate rise we've seen in history, from zero federal funds rate to 5.25, 5.5. That's the fastest rise in history, and there's a lag effect. It's like a minimum a year, 2 years, 3 years. So I don't have, in the real estate space, I'll let you go back and speak to the private equity DSO space, but real estate space, I got no confidence that short-term money, even very good operators who are probably over leveraged, and let's face it, DSOs, private equity, highly leveraged, how they're going to make it through with any kind of promises of the back end quote profits that were promised in real estate. So I'll let you jump back into your space and give me why you feel so confident that they're going to get there, even if it takes longer than 18 months.
The truth is that nobody knows, right? Nobody knows how long it's going to take. Nobody knows when interest rates are going to cool off. Hopefully inflation has cooled off. It's going to be really fascinating to watch what happens with interest rates entering into an election year where the current administration is not going to want us to go into a deep recession, at the time of election, but a lot of this is out of their control. I'm confident in the sense that there are some DSOs that are fantastic operators that were built for long-term sustainability and are turning a significant profit at the corporate level and can absorb these interest rates. They have plenty of cash flow to survive, hopefully what will be somewhat of a short-term interruption. Now, obviously, if it's prolonged and we're talking 24, 36, 48 months of sky-high interest rates, comparatively speaking, to where we were a couple of years ago, and constrained capital markets, everybody's going to be under a massive amount of pressure. So when we talk about these macroeconomic impacts, they're not isolated to dentistry or DSOs or private equity.
No, not at all.
Anytime we're gauging risk reward and looking at investments, I think it's important to understand that, yes, it does impact private equity potentially exponentially more than it does other types of investors because of the short-term debt nature and the 3 to 5 year recap cycle. But it's going to be challenging across the board, and it's eventually going to impact, stocks, as well.
Yes.
So I'm confident in a handful of DSOs that we do business with on a regular basis that we trust and know are strong operators and know that they're not over levered. I'm confident that there's going to be DSOs fail or be absorbed by these strong operators that, have a good balance sheet and ample capital. But the real answer is nobody knows. We don't know how long this environment is going to last and what the long-term impacts are going to look like. And I definitely agree with you in the fact that it takes a year, sometimes 2 years, for these macroeconomic events at their inception to actually play out and bleed across the broader marketplace. So we're just starting to feel the impacts of the constrained capital markets and the interest rate environment that we're in.
Yeah, no, I think we are definitely on the same page. And you're right. I am not pointing a finger at private equity and DSOs. You're right. It's the entire realm is all affected to different degrees. So again, I'm going to use my basis of what I've learned and continue to learn in the real estate markets, but I want to play it back to you because again, you're a trusted advisor. You're a resource for many people. When I look at real estate today, I'm much more, as I know you are, judicious in looking, behind the curtains, under the covers of the entities, the operators, in this case, in real estate, who have had a good track record for the last 3, 4, 5, 6, 7, maybe 7, 8, 9, 10 years. Have been really good, and we've done many investments with them, and so far they've been good people. But there's even some of these quote good people who have been good operators in the prior to the rise in capital, who are hitting headwinds right now, as we would expect some people. So for me to really know, other than just, well, this operator's been good, but how do I know? Well, you just mentioned financials, balance sheet, cash flow statement, P&Ls. We are digging in super deep in that arena, like we haven't done before. What do you do on behalf of your clients who come to you? How much vetting can you do? Because you said there's 400 to 500 right now. Or do you just cull it down to a certain number? And if somebody wants to come to you for consideration, Brannon, as a transition broker, seller side based, to say, hey, we'd like consideration. What kind of a team bandwidth and how deep do you go, and how recent of financials do you look at? Because these things are changing, as you know, like every month, every quarter, things are massively changing. So how do you and your team keep up with that? That's what I would want to know if I was in the space wanting to say, okay, who's good, who's not good, who's in trouble, who's a good operator.
It's extremely challenging. I'll be, completely transparent about that. Even if you're able to get a hold of the balance sheet and the P&L, making sense of it's going to be a formidable challenge.
Well, you said even if you can, why can't you? Why can't I can't not you personally, but why can't we? Why can't we get a
private equity is relatively guarded about releasing financials.
I wonder. I mean, again, I'm just speaking truth here. Wonder why?
Your guess is as good as mine, but I think we know why. I think you definitely need to ask. Can I see the balance sheet? How leveraged are you? Who do you bank with? You need to do research on the private equity firm as well. And how long have they been around? How successful have they been in other medical verticals? How successful have they been in dental? But you also have to evaluate the fact that we're operating in a completely different set of circumstances than we were previous to the past decade. So we will partner with the doctor's accountant a lot of the time, request financials from the DSO, get as much information as we possibly can, and get as granular as we can, put our heads together and try to make sense of it, and figure out if they are well capitalized and if they're built to be sustainable and survive this next 12 to 24 months. But it's not easy. I'm not going to act like it's easy. I will say in some regard we bet on the people and the pedigree of the people behind these DSOs. When you interact with all of these DSOs on a daily basis, and we say there's 400 to 500, we only work with about 40 to 50 on a regular basis that we know, that we trust, we feel like they have a good deal structure, sustainability long-term from that perspective, they buy good assets, they have well-qualified management teams, and they have real infrastructure. Those are the things that we often evaluate. It's relatively easy for us to tell from conversation to conversation which DSOs are built in a way that they intend to be successful long-term, and then those that are more like a, consolidate and flip model. It's black and white when you're talking to their management teams, their business development teams on a daily basis. But from a granular financial perspective, it is very difficult to tell them apart.
I don't know if you caught this, but this was something from the Financial Times just last month. Apollo Global Management, one of the larger private equity firms, the CEO Mark Rowan was stating this. He says, a lucrative age for private equity buyouts has ended, prompting an abrupt shift in the $4 trillion industry where returns will no longer be fueled by rising valuations. He says, in the private equity business, this year has really marked the end of an era. He says a decade of money printing, fiscal stimulus, and as we both said, low interest rates that has pulled forward economic demand is in retreat. He was warning his investors. He said, we face a period of lower growth. Well, all this is built on growth, is it not? So lower growth, higher interest rates, which have raised the buyout industry's cost of borrowing to take companies private. Private equity groups enjoyed an extraordinary run of profitability in the past decade as low financing costs and buoyant financial markets made it easy to sell investments for a gain. He says private equity firms are going to be forced to go back to, listen to this, Brandon, go back to investing in the old-fashioned way, actually value, right? And as you said, not just consolidation and flip, which is, again, it's happened all across the real estate space. I mean, that's all we've seen until recently, until the consolidation and flip, what I call financial engineering, is no longer a game. He says they'll actually have to be very good investors. He goes on and just talks about some of the other aspects. I think the last thing he said, I'll stop. He says he warned against overconfidence in what many have dubbed a golden age for private debt, saying that financial literacy has actually gotten quite sloppy. So that's obviously, I don't know that Apollo may have arms in DSO. I'm not saying they do or don't. I'm just saying that's actually the private equity firm which made the news. Well, it didn't actually make the news. It was actually the company they bought and raided, which was Yellow Freight, a 100-year-old company, which a lot of people heard in the news a month or so ago, bankrupt 100-year company. Apollo was the private equity firm that did business with them. So, if we go back and look at the rise of private equity over really the last 80 years, I mean, it started in like 1946 and really didn't start get going, private equity, until like late 70s. ERISA changed, and then all of a sudden we had what was termed then the corporate raiders of the 80s. Carl Icahn, right? I mean, most people can at least know that name. And that's where the run-up started, and where private equity started to make its gains. And it's gone through boom bust periods, just like the rest of the markets have. And so I think Rowan, just from a high level, is saying, be very careful. And that's what you're saying. That's what you're saying. And I just think, well, I just, as you do, I'm an advocate for our people. And I want them to be careful, because I just think we're very late cycle across the board, and it's a mania. And here we've got docs who have worked their whole life or many, many years to build up, an operational efficiency in a business, and they have equity that they have nurtured along the way. And the lure of, I can get this big multiple. Well, is it a sale? Nope, it's a buyout. You get so much upfront, and the rest is back-ended. Keep your fingers crossed. Good luck. So if I could say this, and I'll be quiet. If somebody can get on the front end, it's typically around 60% today. It's no longer 100%. It's no longer 80. They've just been dropping it down, de-risking their platform, by the way, and putting more risk on the seller. So if you can get the 60%, if that's still what it is, without clawbacks, where you could actually do a walk away with your 60 if you wanted to, or you could stay on the back end and run out your 3 to 5 year contract. And if that works, icing on the cake. If you can get 60% and feel good, is there anything wrong with that, or am I looking at it the wrong way?
Well, I certainly don't think there's anything wrong with that. If you can get 60 to 70% cash at close, and that's enough for you to fund your nest egg, and you would be able to sleep at night if the rest of the investment evaporated, I hope it doesn't, but it's certainly possible, especially in the environment that we're in, then yeah, I mean, it's worth considering. It's worth taking a look at. I don't think all DSOs are going to fail. I don't think all private equity backed companies across all the different verticals that they've been investing in for the past 20, 30 years are going to fail. But there's no doubt there is more blood in the water. There's more risk than there's ever been in the marketplace. I don't disagree with anything that article said. I think that from a DSO perspective, you've got to scrutinize the opportunities more than ever. You've got to be a good investor, not just an investor, right? And you've got to focus on organic growth. How do you make the companies that you buy better? How do you grow the practices that you partner with? And finally, almost every DSO is focused on actually operating the assets they're acquiring and organic growth, because it's a huge talking point, more and more so as banks look at who they're going to lend to and as institutional investors look at who they're going to buy. So all of those things I think are critical, and we'll see, which DSOs it's, too little too late. If they've just been in the business of acquiring every asset that came across their desk with no intention of operating them long term, they are, or they're going to be in trouble. But we warn all of our clients that there is risk in these transactions. And I always cringe when DSOs, private equity, they put an offer in front of a doctor and it shows that they're going to get, a 10 or 20x return on their equity. Their practice that does $2 million a year in revenue and $400,000 in EBITDA is going to be worth, $40 million over the course of the next 20 years. We're conservative in the sense that we normally factor in one conservative recap. If you're going to make a decision about selling your practice, we're going to look at the no sale scenario and then sell it to a private buyer at some point down the road, maybe 5-7 years from now, versus selling to a DSO, taking 60 to 70% cash at close and hitting one successful recap at a modest return, typically around a 3x return on equity. But the days of DSOs generating 5 to 10x return on equity, those days, if the environment we're in right now perpetuates for the next 24 to 36 months, those days are over, at least for now. We're going to enter a period of time where returns are somewhat muted, and doctors need to be prepared for that. If you're being promised a 7x return on your equity or a 30x return on your equity over, the course of 20 years, you cannot make a decision predicated upon viewing this from that long of a perspective. So we normally say, if the decision is solely economic, we look at it on, a 5-year window comparative to not selling. If it's longer than that, if the window stretches 7 years, 10 years, 15 years, from a pure economic perspective, not selling your practice, hanging on to it, continuing to reap the rewards of that EBITDA on an annual basis, and then selling it to a private buyer in a more traditional sense down the road, or even gifting it to your associates,
right,
you're going to win comparative to selling to a DSO, unless multiple recap events happen, which is, a far-fetched conclusion. Could happen. It has happened in the past, but the past 10 years are not necessarily indicative of what's going to happen over the next 10 years. One point I want to make, David, we didn't get involved in this marketplace and the DSO private equity side of the business to convince doctors to sell their practices to DSOs and private equity. We built our company for 30 years on doing traditional practice sales, doctor-to-doctor practice sales, and we still do a ton of them, actually more than ever today. We got involved because thousands of dentists every year were making the decision to sell their practices to DSOs without really thinking it through, and without creating optionality, without creating a competitive environment, without really understanding what their EBITDA was or what their practice was worth or what these deal structures actually mean. That's why we got involved. So there is risk involved in these deals, but the reality is a lot of dentists, irregardless of those risks, are choosing to go down the DSO private equity road. And we just want to make sure, if they choose to do so, that they get the best possible outcome they can.
Well, I couldn't say it any better than that, Brannon. I think you just you put a great cap on this conversation today. I always enjoy speaking with you, and I do know you very well enough to know that you do a deep dive and you are looking at the different aspects of where the opportunities are and where the challenges are, and you're certainly aware, probably more than most, about the challenges of the environment. So, as always, I appreciate the opportunity to converse with you and have the time to put some of the message out to our constituent colleagues in the space, so that they can hopefully find the resources and get the advice that they need before they make a demonstrable decision, which definitely is going to be life changing. Hopefully for the positive. Make the wrong one, could be a negative, but we don't want that.
Yeah. Thanks for having me, David. Always a pleasure talking with you.
Thanks, Brandon. If you enjoyed watching or learning from this video, please leave a like and subscribe to my channel for more content. If you have a question about any of my content or this specific video, just please leave a comment down below. And as always, stay focused on your freedom. I'll see you next time.